And now we turn to China and Asia and problems that continue within China, which are, it's funny because what we've talked about is come to fruition completely and continues to worsen. But yet there's this view that there's going to be some saving grace, magic bullet. And, somebody had a comment saying that, the CCP is going to change directions and do a 180. And it's just unlikely because they don't have the right systems in place to do that. And that's going to be a problem, especially when you look at this sliding because remember, for those that that don't know, Xi declared that everybody in China is out of poverty, that there is no poverty, and that they've defeated poverty. And again, how you define poverty can be of a sliding scale, but a lot of those people are, not surprising, sliding back into poverty. And so there's a big focus on bridging that gap and not showing him to be wrong. And I think people are expecting a broad support, but it's going to be weighted to that lower component, and they don't spend on stuff. They just need to survive. And when you look at recent rice pricing, when you look at recent flooding, it's going to be difficult given the tightness that's in that market, especially as things continue to struggle. Now, foreign reserves were right in line with estimates, but one of the things that we're going to talk about a lot during this segment is going to be exports, imports. So one of the things when you look at imports, for those that have been following us forever, for anybody that follows imports, exports, imports are a leading indicator for consumer demand and exports. And if if imports are better than expected, but exports are weaker, typically that'll reverse, but when you look at imports continuously being down, that's a problem. And imports year on year were expected to be down 5.6%. They were down 12.4%. That is a sizable miss when you look at the market in general. Exports were expected to be down 13.2%. They were down 14.5%. So you get a sizable move lower. Now, when you look at doing it on local, exports were down 9.2%. Imports were down 6.9%, which is well below where they were in June. So again, a continuous decline that we continue to see. CPI was expected to be down 0.4, was down 0.3. PPI was down 4.4%. So that is a good thing. But at the same time, if CPI is down, and we're going to dig into what CPI was up, what was down, why that's going to be an underlying issue when you look at, okay, well, what if it's down, then people aren't spending. And if people aren't spending, then the consumer stays weak. Now, China is again, they're talking a lot about economic support, but that's just what they're doing. They're talking about it. So January to March, we had commentary on stimulus 6 times. April to June, it was 9. And now April to June, think April, May, June, 9 times. Now July through August 8th. So essentially, let's call it 6 weeks. So in 3 months, they said it 9 times. In 6 weeks, they've said it 8. Now, again, they've been saying it. I still haven't seen anything. I mean, maybe you have and I've missed it, but there is still nothing that has come out that isn't just an extension of what was done previously. And for those that think that, it can easily happen, well, let's look at the pressure that we've been talking about. For those that have been listening to us, I have talked about LGFVs, local government finance vehicles. We've talked about special purpose bonds. We've talked about MVPs. We've talked about a lot of these structures that have been used and abused to this point in time. China's local government financing vehicles are showing more signs of stress, with a record number missing payments on popular type of short-term debt last month. So again, LGFVs were pulled forward. They asked them to accelerate them. So a lot of provinces have tried to use them, but as we've been saying, nobody wants them, and they're going to things that are losing money. So now a total of 48 LGFVs were overdue on commercial paper, which typically carries a maturity of less than a year, up from 29 in June. Their missed payments amount to 1.86 billion yuan, or $259 million US dollars, versus 780 million. The revelation is set to aggravate concerns about the financial health of LGFVs, which are mostly tasked with building infrastructure projects that may take years to generate investment returns. And as we've seen, most of them aren't generating returns anymore. While none of them have defaulted on a public bond, their repayment risk has come under renewed scrutiny after China's state pension fund recently advised asset managers handling its money to sell some notes, including those from riskier LGFVs. So the CCP entity is telling their people to sell these things. What do they know from the CCP about the health of this industry? And yes, there are ways to stimulate, but as we've been saying, the limitations are real. They've been doing these LGFEs for a decade. They worked great in the first 5 years, and then they didn't work so great. And then they slow down again, and now they're in just full-on failure because they've exhausted all of these metrics. But remember, this all rolls up. Local government financial vehicle, a local government. This is a communist nation. The local governments respond and rely on the federal government. It all rolls up, and that's why we continue to see a lot of these problems. Now, another issue is China trade balance with the U.S. As you can see, it has not recovered to any meaningful place, as you can see, versus 21 and 22. And that's not something that's going to change. And it's not, there obviously is political headwinds within this, but there's also just economic. There's just, people are buying less stuff. If you're buying less stuff, it means that you're going to order less. And if you're ordering less, it means that you're just not going to see the same amount of movements, which is what we continue to see. And that's what we've talked about in terms of activity. The largest buyer in the world is not buying to the same degree, and the largest seller in the world is not selling to the same degree, and that's where you get a lot of this economic headwind and growth. Now, this is an important piece because obviously the U.S. is not buying to the same degree, but China revises down exports value by nearly $60 billion. So exports since the start of 2022 are smaller than initially reported. So again, they've rehashed, and they didn't go back and also adjust GDP growth. But this is a way to adjust GDP growth because, X minus Y is a big component of GDP, especially in an exporting nation where any given quarter, 13 to 16% of GDP value is generated from exports, and you just took this down. So China made the biggest downgrade on record to the value of monthly export figures, a move that could paint a more flattering picture of trade data in months to come amid weak global demand. The Customs Authority slashed $10.6 billion from the March data when exports surprisingly jumped, as it reduced the overall value of exports for 2022 and earlier this year. The adjustment creates a lower base of comparison for year-on-year changes, resulting in more favorable growth rates for troubled exports. So if you think of it this way, they've just essentially said that the GDP numbers from that period were lies because they took down all of these values. But they do it, and they've done this so many times on FDI, on consumer, on exports, as you can see in 16, 17, because it helps it look better going forward because the comps are easier. So again, this is a huge deal that just kind of gets swept under the rug, but people are getting wiser to it, which is why the math, everybody always questions Chinese math. This is why. The revisions were highlighted by several analysts after last trade data was published. The adjustments to the March export figure, which brought down the value to $305 billion, was the largest revision in history. So again, you're seeing this fungibility that continues in the market, which is why because this export number was a bit shocking. And this is one of the reasons why we always talk about follow the boats. You can't erase boats. You can't add boats. This is something where you could try to, I guess. But realistically, if it's not moving abroad, that's why we look at some of these different pieces and why we continue to talk about the problems that exist in China. And here's just another one. Now, they also released a commentary that you're not allowed to talk about the slowdown. You're not allowed to talk about negative deflation. It's like, guys, it's like this is people want to say that they're going to get less CCP-ish communist, and then they do things like this where it's like, no, they're not. Like, they've already chosen their path. Xi has been very clear about his path in terms of playing up Mao and the history of the party to do what people think is going to happen, which is do a 180, do this, is abandoning the last 10, 11 years of his movement further towards the Maoish way of doing things. So then when you look at the distress signals, and for anybody that has been following us, we've been talking about how bank deposits for Chinese individuals has increased. But one of the things that we've talked about so much is household savings have risen, absolutely. But the surge in household deposits overstates this increase because there was also a substantial shift among households into riskier forms of savings with WMPs and home purchases versus normal deposits. So when you factor the two together, as we've shown before, even with the increasing savings, most consumers are still underwater by about 20% because almost 65% of the populace is exposed to real estate in some shape, way, or form. So when you look at some of the different pieces, so savings is probably best explained as consequences of worried households. So not only do you have trying to cover losses, but what are you looking to spend? Like, things don't look great right now, so you're going to rush out and start spending. There certainly has been noticeably an increase in economic anxiety among businesses, students, and ordinary people. China's current economic malaise was caused by recent policy changes, including COVID-related policies, or was the nearly inevitable result of the worsening imbalances over the last 10 to 15 years. So, yes, you had, COVID-19 and the zero COVID policy obviously had an impact. But one of the things that we've talked about over the years is that there's been a huge reliance on consumer debt, on getting consumers to participate in housing, in lending, in real estate. And that increases stress and problems and pressure. And that accumulates over time, as we saw with LGFVs, as we've seen with SPBs, as we've seen with all of these movements, and that compounds on itself. And as for anybody that has known me since 2011, I've said that you have to be long China. But at some point, you're going to get to a level where, and I don't know if it was going to be 100 ghost cities, 1,000, 1,000,000. At some point, the can that they're trying to kick, you're going to be kicking it right in front of a stone wall. So your nose will be against the brick, and you're going to be kicking it into a wall with nowhere for it to go. And that's when you get to the law of diminishing returns, which is where we sit. The policies discussed have made things worse, but it matters a great deal for China's future, whether the fundamental problem is long-term structural imbalances or recent policy mistakes. And as for those, we've been saying is it's a mixture of everything in terms of there are structural imbalances that will take years to adjust, and the recent policy shifts have not helped. Cross-border renminbi bond issuance hits a record pace because as we know, the international markets are essentially, I don't want to say closed because they're not closed. There's always somebody that will take a risk, but it's going to be costly. And they may not be able to carry that cost, which again results in less activity going abroad. Real lending rates on consumer loans at some Chinese banks have fallen as low as 3% as they compete for customers amid a fall in demand. So we're still seeing credit, even though rates have come down, you're still not seeing demand. So the cross-border renminbi bond issuance has increased because the SOEs are playing a game with each other in provinces to make things look okay, while the private side and the consumer side shows a little bit of a different story. Chinese developer Country Garden Holdings stock and bonds plunged as note holders said that they haven't received coupon payments effectively due Monday, further worsening the sentiment. Some holders of two different notes said they didn't receive coupon payments as of Tuesday. The investors asked, obviously not to be named, but as you're seeing, there's more pressure increasing. And this is there's a view that Country Gardens going under would be much worse than Evergrande, just given the exposure they have being the largest public entity. Foreign direct investment in China slumps to its lowest since 1998. That is not a good thing. It's not something that we see changing. For those that have been following us, we said this pivot was happening and it was going to continue because nearshoring, onshoring is shifting. New investment drops slightly. And so, again, it's just a matter of percentages, but it's starting and we don't see it reversing up. Because you look at China, they're saying that, or Xi is saying, we want to do more, we want to support, but then, they sent in new auditors, they sent in more pressure. So the trend is to zoom out after nearly a decade of largely ignoring the relationship between China's unsustainable increase in debt and the use of non-productive investment to achieve excessively high GDP growth targets, as we've just described. It is good that analysts and the press finally recognize the extent of the problems, but it's clear that they still don't fully understand. For example, this article cites an advisor who recommends that all stakeholders bear some of the burden: financial institutions, local governments, Beijing, and society at large. This may sound like a very fair way of dealing with a debt problem: share the costs among all affected constituents, but it makes little sense. Financial institutions cannot bear the cost because in that case, they would have to recapitalize anyway. But how do you recapitalize given the situation? Because you're not getting new foreign direct investments. So you're not getting new areas to invest in. You're being asked to invest in infrastructure that is more US-based, US entities, and you're unable to recapitalize because the foreign market won't lend to you at a rate that makes sense. So then you're relying on renminbis, the renminbi bonds, but those are interconnected with different things and over-levered, undercapitalized, collateralized, which creates a bigger problem. Society at large can't bear the cost because previous measures that forced households to clean up bad debt have left them with among the lowest shares of GDP in the world, which we'll show in a second, which is precisely what forced China to rely on surging debt to generate economic activity. In the end, only the government can absorb this cost. It is a communist nation. Only the government can absorb this cost. And it's mostly local governments that have the disposable assets that allow them to do so. But that is dwindling, as we've been showing, with the lack of ability to sell land, real estate, diminishing their underlying revenue generating capacity. It is a structural problem that must be resolved on a structural level. Then you look at diminishing returns from new investments, China incremental capital to output ratio, law of diminishing returns. It takes more money to generate the same level of output. That's what we've been, this chart just, again, what we've been saying. China's consumption share is too low. This is coming back to what we were talking about with China being less than the Chinese consumer being about 37% of the Chinese economy versus Germany, which is about 50%, and the U.S. consumer that is anywhere between that 67% to 70%. So again, that is what they've tried to address with dual circulation strategy, common prosperity, and failed miserably. China's real interest rates rise despite monetary easing. Inflation-adjusted borrowing costs climb as consumer prices stagnate. So again, you're not seeing, in some areas where they're subsidizing it, people still don't want it. And then in other areas, they're going up, and surprisingly, people don't want it because people don't have the capacity for the leverage. And you're seeing a historic decline in new construction, which keeps going deeper. Property construction is stuck in deep decline. Completions have held up because of policy support to finish stalled projects, but developers scaled back new investment as demand weakened and financing became tight. Don't see that changing. Developers started 2023 with a much smaller pipeline than 2022, and you will see that go fully negative and be below, just be below 2019, given the current trend. And based on all the leading indicators, it's not changing, especially when you look at developer financing flows are contracting sharply again. The private developer cash shortfall is widening, all the reasons why we're going to be below 2019. And as we keep highlighting, there's very little growth, GDP growth that can be achieved here, which is why they've started to play with some of these other economics. All the while, China core CPI is still hot. China PPI has come down, bounced a bit, but core CPI, so you're seeing some deflation, obviously, but core CPI is still there. It's obviously below where it is in other places, but that is a concern when you look at China's CPI is negative, expected to be at negative 0.4, it came at negative 0.3, and it's driven by consumer goods. Nobody's buying stuff. So consumer goods is below where it was during COVID. It's at negative 1.3%. So people aren't buying stuff. So discounts are increasing. What they are doing, which we've talked about, is travel. So China's CPI services is up 1.2%. Travel costs are up 13.1%. People are like, you locked me down. I'm not going to go buy a teddy bear or a fridge. I'm going to go travel somewhere because I was locked. We complain about being locked in our houses. You could get in your car and drive somewhere. That was not the case here. So this is where we get the most revenge versus some of the other components. And that's when you look at sales volumes. Residential realtors saw better sales and pricing power last month as mortgage rates declined, but that has since reversed. And especially when you look at revenue and profit margin growth slowed in July and remained below pre-pandemic highs, which again is going to diminish and put that pressure there. China exports, as we've been saying, is now below where it was in 2021. And then when you look at the year-over-year level, continues to shrink. And then when we look at the different levels, the plunge in the FDI measure is alarming. That could mean there is still new investment coming in, but some firms are reinvesting less of their existing profits as firms talk more about supply chain diversification. Again, just highlighting in snippets why it's going to struggle to see that underlying growth. China export prices see the biggest drop in a decade, which should incentivize more more buying because the US dollar, for an example, can afford more, but there's just no demand for it. There's no consumer for it. China's consumer prices expected to decline as they did. And then when we start looking at, despite falling mortgage rates, mortgage debt outstanding has started to shrink, which we don't see changing. Outstanding housing mortgage loans continue to diminish because, as we've been saying, the consumer is under pressure. Japanese real cash earnings were expected to be down 0.9. They came in negative 1.6. Real household spending was expected to be down 3.8, which came in down 4.2. So again, not a great situation to be in when you're looking at some of these potential growth areas. And then when you look at the BoJ, the Bank of Japan FX intervention, they continue to add liquidity, even though, again, they're continuing to create the problem, and we don't see that changing. And then central government capital expenditures within Japan continues to move higher. So again, not much has changed. We still see problems in China. Not much getting better. If you have any questions, please let us know. Otherwise, we hope you have a great rest of the week and a great weekend. And we'll talk to you next week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.